5 to 10 years ago, commercial lending looked very different. Banks dominated origination. Rates drove most decisions, and speed mattered, but relationships mattered more. And brokers could survive as generalists. But that world is gone. And over the next 3 to 5 years, the brokers who understand why that old world is gone will quietly gain market share, while everyone else begins competing harder for worse deals. So over the next few minutes, I'm going to walk through the structural trends that are reshaping commercial lending and how brokers who want to gain share are positioning themselves very differently from those who are getting stuck competing on price. And before we go further, here's where this lens is coming from. I'm Shane Walton, co-founder of the Commercial Loan Broker Institute. And through our work, we maintain an active lender network that's used by brokers around the country to place deals with hundreds of lenders. And because of this position, we get to see how lenders are actually changing their behavior, not just how the headlines describe it in the news. So let's start with where we are right now in the credit cycle. We're coming off of a sustained high rate period. Rate cuts and stabilization is beginning, but underwriting discipline is still really tight. And the bigger issue right now is refinances. Commercial debt maturities are stacking up in a way that forces movement in the market. The S&P Global Market Intelligence has described a commercial real estate maturity wall that grows to nearly 1 trillion in 2025 and ultimately is peaking right about 1.26 trillion in 2027. And here's what this means. A lot of sponsors aren't distressed, but they are misaligned with current credit standards. So demand is staying really elevated for refinances and restructures, extensions, bridge solutions, recapitalizations, SBA, non-bank, and hybrid capital when banks are hesitating. And in the next few years, they're not going to be talking about easy money. They're going to be talking about intelligent capital placement. And in a moment, I'm going to show you the 3 biggest shifts that brokers are missing and how these trends change the way you can win your deals moving forward. Structural shift number 1 is the lender mix. The first big structural shift is that banks are not gone, but they're narrower. They're more selective, more mandate driven. And at the same time, non-bank lenders and private credit is no longer truly alternative. They are institutional at this point. To show this trajectory, private credit capital reached $592 billion in 2024, according to the AIMA, and that is up 78% from the volume the prior year, in 1 year. And the Federal Reserve has pointed out how rapidly private credit has expanded, roughly 5 times, a multiple of 5x since 2009. In the Fed's own words, quote, the rapid expansion of private credit highlights that there's a broader shift from traditional bank financing over to alternative sources. So here's what that means for you as a broker. There are more lender options right now, but there are fewer interchangeable ones. Every lender has a specific risk lens, a defined credit box, limited patience for poorly positioned deals. So the broker role, by necessity, is evolving. The future broker is not a rate shopper to the same degree. They're a capital strategist, someone who can truly align a borrower's story, the risk, the structure, everything with the right capital. And next, I'm going to explain why technology is making this change even more significant. So structural shift number 2 is technology. Automated intake, digital workflows, AI-assisted underwriting, all of these are becoming table stakes. Approval timelines are compressing. Borrowers expect transparency. They expect feedback and speed even when deals are complex. So here's one of the most useful signals in the market right now. Cardiff's 2025 Small Business Lending Trend Report notes that businesses are pivoting away from large banks. Applications are down 44% to 39%, and increasingly are turning online to fintech lenders, with 72% now going directly to non-bank sources. And this matters because borrowers are getting trained to expect technology-driven speed. And Cardiff also cites research that shows that banks with greater AI usage lend significantly more to distant borrowers outside of their market. They charge lower interest rates and they experience lower default rates. The takeaway from all of that is not that AI replaces brokers, it's this. Technology doesn't replace brokers, but it exposes the weak ones. Because when time compresses, when speed is the norm, clarity matters more. Packaging quality gets judged much faster, and unrealistic deals will die more quietly, more quickly, because lenders won't touch them. So now lots of brokers hearing this are thinking capital is scarce, but it's not. So next, we're going to cover the new ways that lenders are filtering and are lending right now. And this brings us to structural shift number 3, selective capital. Capital hasn't left the system. It's become more selective. Risk filters have tightened. Shift number 1, the expansion of private capital, has resulted in more specialized lenders. They find where they have a competitive advantage and they lend there and only there. And then shift number 2 that we covered, the expansion of technology throughout the finance sector, has given lenders the tools that they can use to identify their ideal niche client more rapidly than ever before. And when lenders become more specialized and they are equipped with these rapid filtering tools, this means that a no happens faster than before. But the same is true for a yes. When the answer is yes, it's often larger, faster, and more decisive. So lenders essentially want fewer, better deals. Brokers who are sending lenders a stream of marginal submissions or poorly fit submissions are going to get deprioritized. But brokers who curate and position deals will get pull through, they'll get higher approvals moving forward. And this naturally forces a change. The future belongs to specialists. So next, I'm going to make all these large economic trends tactical. I'll break down the 3 main ways that brokers can specialize, given what's happening in the market, and why specialization isn't narrowing your income. It's compounding your credibility. So this brings us to where brokers are actually winning. Generalists survive in stable markets. Selective markets reward depth in a particular specialty. We're already seeing resilience and growth in pockets like small business lending that's seeing ongoing demand. Multifamily and select CRE niches that are supported by active agency and debt markets. Private credit that's funding those targeted in-between borrowers that banks aren't going to serve. The specialization paths that brokers can choose are numerous, and they include vertical niches like healthcare, logistics, franchises, product niches like SBA, equipment, working capital, and capital stack niches, bridge, mezz, private credit. This isn't about narrowing your opportunity. It's about compounding it by building layer after layer of lender trust, borrower trust, improving your ability to structure, your ability to move faster, place more accurately with fewer mistakes. So let's translate all of this into broker action. Smart brokers right now are doing a few deliberate things. First, they're building a curated lender bench that moves across banks, non-banks, fintechs, private credit, And they're using that bench based on actual deal fit, not just treating it as a giant contact list to run through every time. They're adopting, number two, adopting lightweight tech so that you can meet the borrower's speed expectations without losing the control over quality and fit. And number three, they're upgrading packaging and their narrative discipline so that lenders can understand the deal fast, that they can trust the data and move ahead quickly as they intend to. And number four, they are managing borrower expectations early in the process, especially around what the market will accept for leverage, pricing, timelines, and being aligned with what the market is actually going to support in today's world. And this means that there's essentially a fork in the road for brokers. Moving forward, transactional brokers will compete harder for less business. Strategic brokers may place fewer deals initially, but they're going to build a very durable leverage. And these shifts in the market are going to reward that type of specialized quality leverage very handsomely. You don't need moving ahead as a broker to master everything that you heard today. So go ahead and pick one of these macro trends that you want to understand deeply. Identify the steps that you're going to take to adapt to that trend. And then select one niche that you're going to start positioning toward. If you do this, you will be proactively paving the way for your brokerage's future success. As these market trends accelerate over the next few years, you're going to gain more and more leverage because you're prepared early. And your pipeline will just keep growing year after year. So let's get out there, adapt to the change, give big to your clients and your lenders, and let's make this world a better place together.